Hello and welcome. This is the second video in a short series on covered calls. In this video, we will look at two examples of covered calls that a trader could place on Yahoo. At the time of making this video, Yahoo is currently trading for $33.76 a share. A trader could place a covered call by buying 100 shares of Yahoo for $33.76 and selling a Yahoo call option with a $34 strike price that expires in about 6 weeks. The $34 call option costs $1.58. The trader collects the $1.58 premium for selling the call option. Selling a $34 call option means that the trader is selling a commitment to later sell his 100 shares of Yahoo for $34 a share. If the price of Yahoo is above $34 when the option that the trader sold expires, the trader sells his 100 shares of Yahoo for $34 to the person that bought the call option. The trader bought Yahoo for $33.76. Selling it for $34 means he makes 24 cents a share on Yahoo. In addition, he was paid $1.58 a share up front for selling the option, so his profit is $1.82 a share. If the price of Yahoo does not rise above $34, the option that the trader sold expires worthless. The trader keeps his shares of Yahoo, and the trader keeps the $1.58 that he was paid for selling the option as profit. The next month, he can sell another option and repeat the process. If the trader sells the $34 strike, he collects $1.58 up front. He paid $33.76 for Yahoo, and the $1.58 that he collected up front from selling the call option gives him $1.58 of downside protection, so his current break-even point is $32.18. Selling a call option the next month means that the trader collects another premium, which further lowers his break-even point. Instead of selling a call option with a $34 strike price, the trader could sell a call option with a $35 strike price for $1.16 a share. The $35 call option costs $1.16. The trader collects the $1.16 premium for selling that call option. If the price of Yahoo is above $35 when the call option that the trader sold expires, the trader sells his shares of Yahoo for $35 to the person that bought the call option. The trader bought Yahoo for $33.76. Selling Yahoo for $35 means that he makes $1.24 a share. Plus, he was paid $1.16 up front for selling the option, so his profit is $2.40 a share. If the price of Yahoo does not rise above $35, the option that the trader sold expires worthless. The trader keeps his shares of Yahoo, and the trader keeps the $1.16 that he was paid for selling the option as profit. The next month, he can sell another option and repeat the process. If the trader sells the $35 strike, he collects $1.16 up front. He paid $33.76 for Yahoo, and the $1.16 that he collected up front from selling the call option gives him $1.16 of downside protection, so his current break-even point is $32.60. Selling a call option the next month means that the trader collects another premium, which further lowers his break-even point. Let's compare the two choices. It is important to note that there is a relationship between the cost of an option, the potential profit, the risk of loss, and the probability of occurrence. If the price of the underlying stock rises over the call option strike price, the option is exercised and the trader sells the stock. This is known as being called out. Getting called out closes the trade, which both locks in a profit and ends the possibility of the trade losing money. The price of Yahoo only has to move 24 cents for the $34 strike to be exercised, whereas for the $35 strike, the price of Yahoo has to move $1.24. However, if the price of Yahoo does rise over $35, the $35 strike would have a higher profit level. The $34 call has a much higher probability of being exercised than the $35 call, but the $34 call has a lower profit level. So the $34 call has a higher probability and lower profit, and the $35 call is a higher profit but lower probability. If the price of Yahoo does not move over the strike price, the option expires worthless. The trader keeps the premium he collected selling the call option. He can then sell another call option and repeat the process. The trader's risk is that the price of Yahoo makes a large drop down in a short period of time. Should the price of Yahoo drop, the premium from selling the call option offers some protection from downside movements in price. Even if the price of Yahoo declines some, the trader can continue to sell call options, collect the premiums which continually lower his break-even point, and then let the options expire worthless. However, there is a risk that the price of Yahoo makes a sudden large drop in price, limiting the ability to sell options with a high enough strike price to maintain profitability. Therefore, there is a trade-off between the potential profit the covered call trader makes if the price of Yahoo rises, and the amount of downside protection he receives if the price of Yahoo drops. If the trader sells the $34 call, he collects more up front, so the $34 call offers more downside protection than the $35 call. In other words, if the trader sells the $34 call, his break-even point is lower, which helps cushion him against downside movements in price. If the trader sells a call option with a strike price that is even higher, like the $36 or $37 strike, his profit level is even higher if the price of Yahoo rises, but his downside protection is much lower. So that is an example of two out-of-the-money call options that a trader could sell to place a covered call on Yahoo. In the next video, we will continue looking at the Yahoo example with emphasis on the downside protection offered by selling options that are in the money. I hope that you enjoyed this video. Thanks for watching.